When it comes to making decisions about investing in retirement plans, data shows that the average person just makes poor choices. Why is that?
I mean, lack of financial education. I would think we get all these history, geography courses. I'm not beating on them, but a few finance courses should be embedded somewhere. There's been a dramatic shift in retirement planning in the last 20 to 25 years. Back 25 years or so, most of the financial planning was done indirectly by employers and through employers, professional managers. Basically, I'm talking here pension funds. I mean, most workers got pension funds supplemented with Social Security that gave you a steady source of income in retirement. Most times it was indexed to inflation, so you really didn't have to do much planning. Today, it's more 401ks, which basically means 401ks, 403bs in the case of for-profits. But basically what that means is you need to allocate your own funds. You need to make choices. And honestly, I mean, when was the last time most people had a finance class? The answer is never.
Never, absolutely.
And, so yeah, my point with this is, in some ways, we are all money managers today. And yeah, we just need to understand how allocations work.
This next question comes with a bit of a preamble, but I think it'll really help the folks watching this get a better understanding of what you've been doing. But, when a company offers its employees a 401k plan, the first question people ask themselves is, should I invest? Mm-hmm. And if the answer is yes, then they have to figure out how much and where to invest their funds. But for someone who doesn't have a financial background, making the choices can, of course, be difficult. Your research focuses on an approach that would help the average person, say with a 401k plan, make better and more informed choices with their retirement portfolio. So how did you get into that research? What all did it entail, and why did you want to focus in that area?
I'd been working in finance for 10 years before actually coming back to academia. So I've seen clients do stupid things, for lack of a better word. And yeah, people tend to work on emotion. So that was kind of the starting point for me. Most of my research was starting research. Ideas were kind of started from there. Then back in early '04, I believe, I met Robert Shiller, and he helped me distill some of those ideas. Robert Shiller is a professor up at Yale. He's well known for a book he wrote right after the financial crisis called Irrational Exuberance, basically highlighting that investors, typically individual investors, tend to work on emotion a lot. If the markets are doing fine, they tend to invest a lot more than they should in stocks. If the markets aren't doing as well, they tend to under allocate to stocks. And then you saw the financial crisis. That kind of was pretty much a test case of what Shiller's been talking about. Up to '07, everyone was over allocating to stocks, financial stocks especially, to housing. And suddenly in early '09, no one wanted stocks. People were cashing out of stocks. And that's when people like Shiller were coming in and saying you should be buying stocks. So those were, underlying ideas. I've been doing a lot of other research, but at that point I decided I think we need to start talking and addressing how financial planners think about adding valuations. Valuations can help distill some of that emotion, I think, because valuations, and this is here Ben Graham, Warren Buffett, their idea is valuations is what should drive your thinking. The markets can do strange things. Warren Buffett likes to call it Mr. Market. Mr. Market can do whatever they want on a day. That should not drive your choices. And so it's a combination of all these, a lot of reading, a lot of ideas, 20 years in the field. And part of it was, of course, working at Elon for now 6 years. I started thinking of myself as more of an educator, and it doesn't only have to be as a teacher in a classroom. And that's where most of my research is headed now. Something that's applicable rather than what I did in my PhD, which was a little more cut and dry basic research.
Fantastic. With so many choices, like you mentioned, for everyday investors to face, why is it so important for them to choose that retirement fund wisely?
Remember, I mean, choosing between, let's say, the two classical instruments, stocks and bonds. Bonds have low risk but low returns. Stocks typically have higher returns, of course, but they're volatile. You can lose a lot in 1 year, but in the longer run, stocks have done well. Now, investors need to understand, and that's what research shows. Most financial planners even agree on this, that even someone in retirement needs to own stocks. You just have to. Bonds don't cut it. They don't give you high enough returns for the vast majority of investors. Now, there's a small segment that saved enough, has enough under management, they'll be fine. But most people need stocks. But then you need to understand that stocks can make you a lot of money, but they can also lose you a lot of money in the short run. And that's what this paper is adding to. How do you reduce that risk? Sure, you have risk with stocks, but we believe you can reduce risk by getting out of stocks when they're overvalued and increasing your allocation to stocks when they're cheap.
When all these many people are making all these many decisions, how does that and what kind of impact does that have on the system as a whole?
Sure, and that's kind of what we also talk about, and academia has been pushing this idea since a while, that markets are kind of efficient, and it's really not easy. At any given time, the markets are pretty fairly priced. But people like Shiller, Warren Buffett, Ben Graham back in the early 40s, they've been arguing that markets aren't always efficient. They could be on a given date for most people, but if you kind of distill the noise, take out the emotion, take out the media, or because the media tends to focus, and again, I'm not beating up on the media, but the media tends to focus on winners in good markets, fixate on losers in bad markets. And we tend to push it to extremes. The idea with valuations is it's a little more scientific, for lack of a better word. It'll pretty much force you to make the right choices at any given time.
Let's get a little technical with some of the language here. What are mean reverting metrics, and what metrics did your research focus on, and how do those metrics impact retirement plan investments?
We actually used a bunch of them. We used 3 of them, the 3 traditional ones, or the 3 most popular ones. Price to earnings, that's a very popular ratio. I mean, most analysts would cite that in an interview, pretty much. It's a number we focus on a lot when we're talking about valuations of markets, individual stocks. We also use something that comes with the balance sheet, market to book ratios. And then we use the third one that's not as popular but attractive in academic research, the dividend yield. So basically the P/E ratio tells you, and the P/E ratio is kind of an indicator of the others too. The P/E ratio tells you that when stocks are trading at low multiples, it takes you that much shorter to recover your investment in a stock or in an index. But if the P/E ratio is high, it'll take you a longer time. So if the P/E ratio, let's say, if the markets are trading at 10 times earnings, which is what it was early 2009, it'll take you about 10 years to recover your investment through profits. If you buy into the markets when they're trading at 40 times earnings, which is again pretty atypical, but that did happen in the early 2000s, it'll take 40 years for company profits to return your investment. So the typical financial manager just tells you buy 60% stocks, 40% bonds. Mean reverting metrics like the P/E ratio basically suggest that markets have what we call a random walk around the mean. But at the end of the day, they head back to the mean. The mean, for the way we calculated it, the mean for the P/E ratio for the US markets is about 18 times earnings. And so if it drops well below that, let's say 10 times, 12 times, you should be buying a little more stock than you typically would. But if it goes up to 40 times earnings, your retirement funds should not be as much in stocks anymore. You should be choosing safer investments like bonds.
Fantastic, easy to understand. I like that. Now, in your publication, you indicate that if the strategies developed in your research had been used during the great crash of 1929, the NASDAQ market crash of 2000, and the financial crisis of 2008, there would have been less significant losses in retirement portfolios during those times. How and why?
Sure. So let's start with, let me go backward. Let's start with the financial crisis. Prior to the financial crisis, the S&P 500, the U.S. market, was trading at about 25 to 28 times earnings. Our research was suggesting that you should reduce your the typical investor should reduce their allocations to stocks and move it into bonds. So what you would do is, if your benchmark portfolio is about 50% stocks, 50% bonds, you reduce your exposure to stocks maybe down to 25, maybe even down to 0. So when the markets actually crashed, you actually don't lose a lot. You're sitting in bonds. Now, when the markets turn around and they're down to the mean, about 18 times earnings, which happened around late 2008, that's when people like Warren Buffett were saying you should be buying stocks. They're really not expensive. Or as Robert Shiller said back in early 2009, and this is something I played for my classes back then. He actually said you should be buying stocks. Am I going all in? No, but I'm definitely I'm raising my allocation to stocks. And so you would have reduced the risk of losing capital, but you would have also taken advantage of the comeback in stocks.
Gotcha. Now, you're also currently writing 2 other papers, as I understand it, and have other research in progress. Can you tell us a little bit about what you're working on?
Sure. The 2 papers that are kind of ready to get out, I still need to work on them a little more. But those are focused on something I'd done during my dissertation days. We've got feedback from journals, and I need to incorporate that. But that's a little more technical, more on customer lifetime value. It's an interdisciplinary area of market. It's a mix of marketing, accounting, and finance. But the research that I'm really developing now is extending the same paper to global markets. We found a database that actually extends results to the late 18th century for the US, the late 16th century for many European countries, and some developing countries back to the mid-1900s. So that's a goal, to show that it's not only the US. That's when it becomes a little more accepted, and maybe actually develop the thought that we need to be global investors. It's not, globalization doesn't only mean global travel or global businesses, but it should actually be global investing. And yeah, so I'm really excited about that study.
How is it that you decide where to focus your research, and how do you see it used?
Yeah, I mean, again, when you start off with a dissertation, it's typically more, your typical research areas are research that's focused more on academics. So I still do some of that, but I guess as the Elon philosophy, that I've started feeling that I need to do research that adds value to the broader community, practitioners of finance, individual investors. So my areas, again, financial planning is a big one, but the other big one, and I have 2 publications in that, is sustainable investing, because there was this idea that with sustainable investing, focusing on only stocks or industries that are more sustainable than others, more green than others, you're actually giving away diversification. You're giving away profitable opportunities. But the research on this is mixed in the area. Christy Benson, she's a professor of business law. We started talking about it. She'd been looking into the area. We combined some research we were doing and found that actually that's not true. There are many, many green companies, sustainable businesses that actually do very well. You're not losing out on anything. What you're actually getting is good, well-managed companies that give you stable returns. Returns that are not very much lower than the rest of the market. They may not outperform the markets, but you don't lose out. And that in itself is an important idea.
What are some of the other ways that you see the research that you're doing as relevant these days?
Again, like I'd say, the financial planning area clearly. I mean, as I started the interview with mentioning that we're all money managers today. We have to make the choices. You have no option. And there's lots of research that suggests that the average person spends more time every year planning the next vacation than their retirement portfolio. You need some simple ideas out there, just out there, so people can read them, understand them, and that's the goal. That's the goal of this research. It's still technical enough that you'd maybe need a financial advisor to explain it to you, but it's also educating financial advisors instead of just going with passive investing, which works for many investors, but investors with low savings, the ability or the need to take a little more risk, this actually ends up reducing your risk.